Alrighty. So in today's video, we are going to be talking about Iron Condor management, right? So whether should you be holding, rolling, or closing your trade based on the different scenarios, right? So this is going to be a little bit like a trivia. So what I'm going to do is that I'm going to show you the trade, then I'm going to present you the different scenarios. Then for each of the scenario, I'll be giving you 3 of these options, right? Basically to hold, roll, or close. Then I want you to decide which is the one that you will go for. After that, I will give you my answer as well. All right, so I've actually done the credit spread version of this. So if you haven't already watched that, I'll put the link at the top right hand corner of this video and you can go ahead to watch that. All right, so let's get into this. So here is the trade, right? The trade is a $5 white Iron Condor with the strike price at 160, 165. So this is for the put spread side, as you can see down here. And then you have the call spread side, which is 185, 190. You combine this two, you have the Iron Condor, and this is a 45 DTE trade, and we sold it for $1.50, right? So this is the credit that you will receive. So here's a question for you. If this is a $5 white Iron Condor and you receive the credit is $1.50, then what is the risk? So if you don't already know how to calculate this, it's very simple actually. Basically what you do is you take the width of the spread. So in this case, it's $5 and you minus off the credit which you receive, and that is $1.50. So what is the remainder? The remainder is $3.50. So $3.50 is the max risk that you can incur on this very trade, right? So for a single contract, that will be $350 in terms of risk. Okay, so now let's move on to the first scenario, and that is, what if the market stays inside of your short legs and your Iron Condor is now $1.10 and there's 30 DTE left to go? So do you hold, do you roll, or do you close? So take a moment to think of your answer and then I'll give you mine. All right, first of all, if your Iron Condor is now worth $1.10 and you sold it for $1.50, what is your P&L now? Are you in profit or are you in a loss? Well, the answer is that you're in a profit because we sold at $1.50. So for us to make money, we have to buy back at a lower price than this $1.50, right? So for example, if you close out this trade right now, it will be for $1.10. That means your profit will be 40 cents, right? Which translates to $40. Okay, so what is the answer? So my answer is that I would hold on to this trade. And the answer is because that there's still a lot of time left and it's also not yet at 50% profit, right? 50% profit will be roughly at 75 cents. So there's also no point to roll. So as you can see down here, I've canceled out rolling because your trade is in a profit, right? So it's working out well. So generally, there's no need for us to roll if your trade is not in a pickle, right? Basically, your trade is not being tested or it's not in a loss. There's no need for you to roll. All right. As for closing, you can actually close this if you think that you've already gotten enough out of the trade, right? You think that, you know, 40 bucks is good enough because it already made 40 bucks in what, 15 days, right? And let's say, for example, you have a new trade opportunity that you want to get into. So what you can do is that you can close out this, right? Free up your buying power to redeploy into the other trade, right? So this is something that you can do as well, right? But my preference again would be to hold. So scenario number 2, so this time is the same as well, where the market is staying inside of your short legs and your Iron Condor is now worth 75 cents and there's 30 DTE left to go. So in this case, you've already hit 50% of your profit, right? You've already made about $75 in 15 days. There's still 30 days left to go. So do you hold, do you roll, or do you close? So in this case, I think there are 2 answers that's perfectly fine, right? You can either hold or you can either close. So for me, I would choose to hold because there's still days left to 21 DTE, but you can definitely still close it because, you know, you've already reached 50% of the profit, right? So why do I say, you know, I want to hold on to it rather than close it, right? So as you can see down here, I brought up this table down here, which is a study that is done by the Tasty Trade research team. So what they've done is that they did a lot of research on this 20 Delta $5 white Iron Condor, right? So they tested it based on different exits. So they have the exit based on, you know, holding it to expiration, exiting at 50%, right, when there's 50% profit, and exiting at 21 DTE. So as you can see, this is the result down here based on the daily P&L, that if you hold to expiration, your daily P&L is going to be the worst, right? The second is 50% winner, and 21 DTE is the highest. So basically you have the best result if you exit at 21 DTE. So that is why, I choose to exit at 21 DTE rather than just get out at 50%. Now there's a caveat to that. That means to say, let's say instead of one contract, you actually trade two contracts. Basically, you have two Iron Condors. So in this case, you can actually take off one at 50% profit, and then the second contract, you can actually leave it to 21 DTE before you exit it, right? So this way, you have more choice. You have both of them, and then you can control your volatility better. And the reason I say this is because, let's say, for example, you close out at 50% profit, right, for the first contract. Now, what if the market suddenly makes a big move to either of your strikes, either the call side or the put side, and then all of a sudden that now becomes a loss? So the good thing is that the first contract, you close out at 50% profit, so that is going to, negate quite a bit of the losses that you sustain on the second contract. So in this case, what you're doing is that you're really managing your P&L volatility. Now, of course, there's still a chance that, when you exit at 21 DTE, the profit is going to be even bigger than exiting at 50% profit, right? So in this way, at least you ensure that your P&L will be kind of pretty smooth rather than, have one big upswing or downswing either way. All right, so again, either 50% or 21 DTE, and I wouldn't exit at expiration, right? There are still quite a bit of risk exposed, which I'll share with you later on. And as for rolling, right, I wouldn't say there's any reason to roll at all because the trade is in a profit. Scenario number 3. So for this, the market also still is inside of your short legs, and your Iron Condor is now worth 90 cents. And there's 21 DTE left to go. So what do you do for this? So in this case, you probably only make 60 cents, $60. So it's slightly a bit off from your 50% take profit, but there's still some profit, and there's 21 DTE left to go. So what do you do, right? Do you hold, roll, or close? So for me, my answer is that I would close, because again, studies have already shown that when you exit at 21 DTE, you will get a better result over the long term than holding to expiration, right? So as you can see down here, this is the study done by the Tasty Treat team again. The research team have shown that when you exit at 21 DTE, your results is going to be much more better. It's going to be superior than if you were to hold to expiration. Again, when we are entering into trades, especially option trades, we want to lean a lot onto studies, right, on statistics and probabilities, because options tradings is very backed heavily by numbers, right? So if there's already the research done, the studies have already done, and as you can see down here, these studies have been dated all the way back to before 2007, right? This is even before the financial crisis in 2008, and the study has been for more than a decade, right? Even past 2017 to 2018. So you can know that the studies that they have down here is very statistically relevant. So that is why I would just close off the trade, because it's already hit 21 DTE. Now as for rolling, there's no need to roll again because you're in profit. Now as for holding on to the trade, I've actually got quite a few people that have reached out to me, and they ask, right? They say that the short strikes, the short legs have not been tested, and it's still well within the profit zone of the Iron Condor. Can they still hold on to the trade? So in this case, my answer is that yes, you could if you want to, but you need to be aware that while the market could still stay within your short legs, which is the profit zone, and can increase your profits, the market could also easily make a big move and turn the trade into a loss, right? So let me just remove all the drawings down here. So let's say, for example, right now, the market could be at this point, right? And maybe at this point, you are in profit, right? 21 DTE left, and there's 90 cents left. Now, if the market continues to stay there, right, towards the expiration, then yes, you're going to be making much more, right? Because all the extrinsic value will start to erode as it gets closer to expiration. But on the flip side, you also have to be aware that the market could still easily make a big move, right? Because what if the market goes all the way down? So at the point of time, you could have secured a profit, but instead you wanted to hold on to it, and now the market has went down and now it became a loss, right? So this is something that you need to take into account and just be aware. Scenario number 4. So now the market has went down and is near one of your short legs, and your Iron Condor is now worth $2, and there's 30 DTE left to go. So at this point, you notice now you are losing money, right? So in this case, you're losing $50. So at this point, do you hold, roll, or close.
By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video.
So my answer is that I would still hold on to the trade because my short leg has still not been breached and the market could bounce back up. Again, by the way, this is just for the put spread side. So if the market actually goes up to the call side, then it will be the opposite, right? So it's pretty much just the mirror of this. So for rolling, you could choose to roll the call spread down. So let me just remove this drawing. So you could actually just choose to roll the call spread down to get some credit to cushion the loss if the market continues to go down. But then again, you need to be aware that there is the possibility that you can get whipsawed if the market suddenly bounce back up. So some people have asked me before, they want to always reposition their deltas every few days or weeks. Basically, they just want to get to as delta neutral as possible. So generally, the idea down here is that if the market, moves away from its central point and it moves closer towards one side of the legs, what they will do is that they will roll down the untested side to kind of neutralize the delta. And the thing with this is that you can do that. However, you may get whipsawed because remember, when the market goes down, it's still going to be pretty near where you're going to roll this call spread to, right? Let's say, for example, you roll the call spread down to here. So now your new call spread will be over here. So at this point of time, it's still pretty close, right? The market could just go back up, and then now what are you going to do? Are you going to roll this put spread up, and then it's going to start to reduce the profit zone? So one thing is that when we roll, of course, we're going to narrow our profit zone, right? And I mentioned this before. So the key down here is I don't want to narrow the profit zone too quickly, right? Too soon. I only want to wait until either of my strikes get breached, either of my short legs get breached before I roll the untested side down, right? It's almost like something like an emergency fund, right? You do not want to tap into your emergency fund unless there's an emergency. So in this case for Iron Condor, right, I wouldn't say it's an emergency, but rather when it actually tests our short strikes, that's the time when I would consider rolling, because at that point of time, the market is really pretty far away from the other side, right? So let's say if the market goes all the way down here, right now the call spread is very far away from where the current market price is. So when I roll it down, at least, right, it's not going to be so near compared to at this point that it can easily, get tested again if the market just suddenly shoots up, right? So this is just my thoughts about this. You can choose to follow it if you want to, or you can, if you want to have your own way of rolling or your own way of thinking, yeah, by all means, go ahead and apply that as well. Now, as for closing, I wouldn't consider closing because there's still time left for the trade to work out. Scenario number 5. So right now the market is near one of your short legs, and the same thing as well as scenario 4. Your Iron Condor is now worth $2, but this time there is 21 DTE left to go. So what do? Do you hold, do you roll, or do you close? So for me, my answer is that I would just close the trade again to adhere to exiting at 21 DTE, because again, studies have shown that when you exit at 21 DTE, your long-term performance is going to be better than if you just hold all the way to expiration. Now, what about holding and rolling? So as you can see down here, I've already put it in the orange box because they are possible choices for you to go for. But if you want to hold to expiration or until the trade is back in profit, then you want to be aware of the possible risk. Like I mentioned before, the trade could go further against you, right? It could go further down, and then now you incur an even bigger loss when you could have gotten out at a smaller loss. And alternatively, you could also choose to roll out the whole spread if you can get a credit, right? Basically, you roll the call spread and the put spread out to a further DTE, and then you get a credit. And when you get a credit, basically you're prolonging the trade. In case the trade might work out in your favor, the market goes back up. All right, let me just remove this. So in case the market goes back up, then your trade will now be in a profit, right? But one thing to understand is that this rolled trade, right, is basically just putting on a new position, because when you roll it out, what you're doing is that you're just closing the existing trade and then putting on the new one. So when you put on this rolled new trade, so to speak, it will actually have a lesser probability of profit than the initial trade, right? Because when you put on the initial trade, your wings, or rather your short legs, are on the opposite end of where the current price is. But right now, because it's very close to one side of your strikes, what you're doing is that you are starting off this new Iron Condor, this rolled Iron Condor, at a lower probability of profit, because right now the market is very easy for it to just breach the short side, right? You can just very easily just go down and then breach the short put side. So that's why your probability of profit is actually lower than the initial one. Now, scenario number 6, the market has breached one of your short legs and your Iron Condor is now worth $2.50. So right now you are losing about $100 and there's still 30 DTE left to go. So right now the market may have just breached your short put, or it may have gone even further down where it went past, you know, your long put strike, right? So what do? Do you hold, do you roll, or do you close? Well, for me, my answer is that I would roll down my call spread to get more credit to cushion the loss, and I generally won't roll only until either of my short legs get breached. As for closing the trade, I rule that out because it's not near the 21 DTE yet. And the final scenario, so scenario number 7, the market has breached one of your short legs and your Iron Condor is now at $2.50. So the same as scenario number 6, the difference is now there's 21 DTE left to go. So what do? Do you hold, roll, or close? So I'm pretty sure that you already know my answer by now, and that is that I would just close the trade out for a loss. And the reason is because it's already at 21 DTE. So it's not possible to avoid losses. That's one thing to understand. I've had even people emailing me, asking me, you know, how can they put on trades and not have a single loser? Every trade they want is to be a winner. Unfortunately, there is no possible way. If you do find a way over 1,000, 2,000 trades, then please contact me. I'd like to know as well. But for the most part, if you were to just take a look at probabilities by itself, you know that it's impossible, right? Because when you put on an Iron Condor trade, the probability of profit will be roughly around 65% win rate, 70% win rate, just based on the theoretical probability. And this is roughly around 20 deltas for the short legs. So what that also means is that there is still a 30% chance, right? 35% chance even that you could lose on your trade. So this is one thing that you need to understand. So when there's a loser at 21 DTE, I'm just going to close it out. So if you choose to hold and you don't want to close the trade and you don't want to take the loss, then you need to understand the potential risk in doing so. So first of all, yes, the market could come back up, right? Let's say, for example, you went all the way down here. The market could certainly go back up, and then now you're in a profit, and you know, suddenly you're like a genius, right? Because you held on to the trade. But then again, you need to understand that the market could possibly, you know, go the opposite direction, right? It could go further down and then you increase your losses. At the same time, don't forget that there is an early assignment risk. When you get assigned on a short put, there will be long 100 shares of the underlying. If you're exercised or assigned on your short call, then there will be 100 shares that you're short at that position, right? And this could lead to a margin call if you don't have the funds. So the risk is pretty big down there. So that is why I do not like to generally hold past 21 DTE. So as you can see down here, again, this is the same graph I showed earlier. So although you can see that 21 DTE is a profit, you notice that there are bumps along the way, right? You can see that the market has actually dipped down quite some time before going back up and then dip down again. So as you can see somewhere around this timeline down here after 2017, you see there's a big drop, right? There's a big drop, but then after that, the market starts to recover again and then come back down a little bit. And basically, it's just going to go back and forth until eventually it goes back up again. So the losses are there, but that doesn't mean that you won't be profitable in the long term, right? Again, as long as you stick to the mechanics and you manage your risk well, then in the long term, you will definitely have a good chance to be profitable. And finally, rolling is also possible if you can get a credit. But understand that the roll trade again would have a lower pop than the original trade. Alright guys, so I hope this video have helped you get more clarity on when you should be holding, when you should be rolling, and when you should be closing your Iron Condor trades.
By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.